The latest CMHC real estate forecast for Toronto is in, and let me tell you, if you're watching this video expecting to hear their crystal ball prediction on where Toronto real estate prices might be headed in the next few years, well, I'd say don't hold your breath. But if you're using the information to find out more about market fundamentals so that you can understand where the general direction of where Toronto real estate might be headed, then their report could be pretty useful to help you make smarter decisions. So stick around because I'll be breaking down the details of this report in this video. If you're new here, we're all about helping you make smarter real estate investing decisions in Toronto. Don't forget to like and subscribe if you enjoy our content. Now, let's begin. It all boils down to basic economics when it comes to where the market is headed. When supply and demand are balanced, you can expect a more stable market. However, if demand outweighs supply, then brace yourself for prices to continue to go up more quickly than normal. Now, this fundamental principle holds very true for Toronto real estate and can definitely give you a good idea of where the market is headed. Based on this, let's dive into the supply side of the Toronto housing market. According to CMHC's forecast for 2024, they are anticipating a decline in housing starts in Toronto. Why? Well, it's pretty straightforward. Builders are definitely finding it tougher to find financing in this high interest rate environment, and so many projects are getting pushed back. However, nowadays, fixed rates are coming down, and the expectations are that variable rates are going to follow suit this year as well. And so CMHC does predict that new construction will gradually start to pick up over the next few years. What's probably going to happen is that supply is still not going to reach the heights of the pandemic rush. And what's really intriguing is that housing starts could kick off much more quickly for the low-rise market compared to the larger condo developments. And the reason for this is simply because smaller developers can take action more quickly, and so their supply is expected to pick up faster than the bigger developments. All right, let's dive into the demand side of the equation. Since the beginning of this year, we have witnessed a visible surge in demand, and according to CMHC, this momentum is expected to continue. Generally, the demand is projected to remain stable and outpace supply for a couple of reasons. First, there's the ongoing influx of immigrants fueling population growth. Second, buyers tend to react more quickly to declining interest rates, unlike builders who need more time to strategize and execute their plans. Just keep in mind that interest rates aren't expected to nosedive, and this ultimately means that affordability in Toronto will still be a pretty big issue, and this means that prices aren't really expected to escalate as quickly as before. Now, we talked about supply trends being different in the condo market versus the low-rise market, and it turns out it's pretty different for demand too. CMHC is expecting less demand for condos because a big bulk of these buyers are investors, and in our current high interest rate environment, the negative cash flows in the market simply don't make sense for condo investors. Plus, there are more condo completions coming to the market this year. And so both of these factors are going to continue to stabilize the condo market and subdue price growth. And this will ultimately make it less appealing for condo investors to enter the condo market in Toronto these days. On the other hand, CMHC is expecting more demand in the low-rise market in Toronto, especially with semi-detached and row houses that are at more affordable price points. The demand does come from young families that are looking for houses, and this continues to be pretty stable, and also with the government focus on densifying the missing middle. And so there is a shift of condo investors entering the low-rise market, aligning with the government's new direction and capitalizing on the better rents here in the low-rise market too. All right, let's look quickly at rents too. Now, after shooting very quickly in 2023, we have seen a slight drop in Toronto rents in the past few months. And guess what? CMHC is seeing the same thing and also seeing vacancy rates tick up a bit too. Now, there are a few factors for this. First, the government is scaling back the intake of international students. And second, with declining mortgage rates, we might end up seeing more renters converting into homeowners. And thirdly, recent completions of condos are also adding to the rental supply, which are all keeping rents from soaring and vacancies a tad higher. Now, we might see rents come down in the short term, but CMHC doesn't really expect this to stop rents from climbing in the long run, simply based on supply and demand fundamentals in the rental market too. So looking forward, we are seeing more signs of stable prices and stable rents in the horizon, especially with brighter perspectives in the low-rise market. And this is great news for Toronto multifamily investors. Now, if you are keen on nailing down where prices are headed, CMHC does offer projections, but let's be honest, it's a little bit of a mixed bag. The best and worst case scenarios are all over the map, ranging from a modest 3% increase by 2026 to a massive 24% surge in the best case scenario by 2026. So realistically, it could be really anything in between. So projections are obviously not crystal clear, but here is a clearer takeaway. We probably hit the medium-term bottom in 2023, and going forward, the trend appears to be pretty stable, if not leaning towards an upward trajectory. And for Toronto investors, this is a big game changer, as it means greater confidence in the real estate market in Toronto with significantly lower downside risk compared to a year or two ago. And if you are thinking about investing in the low-rise market, you're probably going to outperform. And if you're wondering, here's how numbers compare. Investing in a 3-unit house could potentially yield at least break-even cash flows, unlike condos, which typically cash flow pretty negative still. Plus, there is a bigger growth potential in terms of appreciation when you invest in a market that aligns with the government's priorities, and you might even see higher growth if you're willing to put in some work. And if you're curious about what specific low-rise investment opportunities there are in Toronto, don't hesitate to reach out to our team. We're here to help you navigate the market and find the best options tailored to your investment goals. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better real estate investing decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add, renovations, and gentrifying areas. If you do want to discuss your private real estate situation with us, just head over to this link to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.